You'll have to excuse me, I've got a rotten cold. We'll start off by a little abstract. The fortunes of mining companies and their implied value are tied to cycles. Hence, the determination of appropriate future metal prices is one of the most critical factors faced by mineral valuators, especially for advanced projects where DCF modeling is the norm. Empirical studies of past forecasts show that the success rate for commodity price forecasting is very poor. Our paper explores various approaches and comments on their strengths and weaknesses, and we conclude that careful evaluation of long-term metal prices is a key element and is hardly a luxury that can be left to simple averages or rules of thumb. There are many analysts, institutions, and specialized commercial data suppliers that provide both short and long-term commodity price forecasts. In addition, the use of an aggregate mean of all available forecasts or consensus forecasted pricing is not uncommon for valuation purposes. An increasingly common method of choosing long-term commodity prices is to average over the past 3 or 5 years. Of late, the use of a 3-year trailing average has become more common in feasibility studies and for valuation studies. Use of a consensus forecast, the rules of thumb approach, or use of market-based prices provide a safe means for a valuator to create the impression that one is removing a subjective view of future commodity prices. Despite appearances, however, reliance is on one or a combination of the above without sufficient justification may prove to be ill-founded. Commodity prices are based on expert opinion or management's reasonable expectations, may be allowed in Canada or Australia. The United States, on the other hand, allows as a maximum the lesser of the 3-year moving average and current spot price, although I may stand corrected on that last point. Although in the U.S. the SME has taken a strong position against the use of the 3-year trailing average, the CIM in Canada has adopted a somewhat agnostic approach. The use of a 3-year trailing average is taken as best practice by CIM, it's accepted by the Ontario Securities Commission, and is deemed by many to be an industry standard. So let's take a look at some metal price charts. I got ahead of myself here somehow. This is an 8-year view of the RBC Base Metals Index. It's even lower today, and certainly below the lows of 2009. Here are copper and zinc for the 12 months up to last October. Not a pretty picture. Many pundits blame China for reduced metal demand, but keep in mind that it is the growth in GDP that is reduced today. Wouldn't we love it to see 6% growth for GDP here? So how do we make sense out of all of this noise and come up with forecasts that are credible? For resource calculations and economic assessments, the use of a commodity price averaged over a period of several years, ending at the assessment date, is common. Feasibility studies often use metal prices averaged over 3 to 5 years, at least as a base case. Industry analysts are increasingly utilizing this approach to determine a project's NPV. In theory, this method attempts to account for the cyclical nature of commodity prices. As both highs and lows of commodity price are temporary, price will eventually return to an average inflation-adjusted price, a reversion to the mean. But what happens if the cycle does not return to the previous trend? In the real world of disorderly, volatile, and varied commodity cycles, such an approach presents a very real problem of how to apply, account, and make sense for these variations if one is using... Sorry, I keep doing the wrong thing here. If one is using trailing averages for valuation. This chart is theoretical. Here's what the real copper price looks like over the past 95 years, up to 2013. Of course, copper prices are now down to $2.15. Would it make any sense to use a 3-year trailing average in a valuation today? Note that from the trough of 1932 to the subsequent peak in 1974, the real copper price rose over 3.5 times. And note the subsequent 28-year downtrend that took us from $3.64 to 91 cents. Then the sharp, very fast increase during the supercycle. I think if I were inclined to use a trailing average, I would want it to be over at least 10 years and inflation adjusted at that. So take a look at the most recent 10-year average for copper. Would you be happy using $2.80 a pound for current valuation? Or how about 90 cents a pound for zinc? So here we run into the conundrum. Is a blindly used rule of thumb acceptable? Is this really reversion to the mean? We are inclined to the view that the use of long-term average prices is, at best, very dangerous, if not tempered with a comprehensive market assessment that takes into account the particular market cycle, where we are in it, and the economic outlook over the life of the subject mine. The use of aggregated mean consensus commodity price forecasts is useful, but these forecasts tend to reflect at least the sentiment and research of many analysts and investors. Consensus metal prices have limitations. Empirical studies of past forecasts have shown that the success rate for commodity price forecasting is very poor. Forecasters often tend to overestimate future commodity prices. Some view the incentive structure of the analysts employed by banks who produce these forecasts as the main reason for these over-optimistic forecasts. Analysts wish to maintain a good relationship with the company whose earnings are being studied. Non-neutral earnings forecasts can have an impact on this relationship on two levels. First, the relationship between the analyst's employer and the particular company, and the personal relationship between the analysts and the management of the company upon whom the analyst relies for his information. Bankers will disclaim that any such problems exist, as they've established all sorts of Chinese walls, don't you know? Well, we are all humans and these biases exist. So biased forecasts can result from human herding behavior as we seek consensus. As commodity prices and economies start to decline, analysts' optimism prevents them from reducing their estimates fast enough. This leads to overvaluation in peak years and undervaluation in trough years. Consensus prices have a role to play, but again, nothing beats an analysis of the fundamentals of metal forecasting. A third approach is to allow for price forecasting risk when selecting discount rates for the DCF model. However, we're still stuck with the same forecasting problems. One suggestion is to apply different discount rates on a line-by-line basis in the DCF model. However, we believe that a process that considers a range of likely outcomes is far superior, as it can incorporate the results of all potential scenarios. This table shows the effects in a very simplistic way of using probability-adjusted NPVs. This method provides a way of illustrating and perhaps removing the valuator's bias, which is reflected in the probability assigned to each scenario. Here's an example of a case where the British Columbia Securities Commission requested a change in the economic analysis for a manganese project in Arizona. The original analysis, shown on the second row in the table, was based on a single price forecast by a marketing expert. The top row shows the effect of changing to a 3-year trailing average. The NPV, second column from the right, drops from $289 million to negative $74 million. The payback, right-hand column, changes from 4.6 years to 10.3 years. This table shows the effect of variable pricing. Mine life is divided into near-term, mid-term, and long-term. In scenario 1, the project comes into production in a rising metal price environment with prices moving from trough to peak. Initially, copper and zinc prices are $2.50 and 70 cents. In the midterm, prices of $3.80 are used, while long-term prices of $3.50 and 90 cents are used. The average prices over the LOM are $3.80 in each case. Scenario 2 assumes single consensus average copper and zinc prices of $3.80. And scenario 3 assumes the reverse of scenario 1. All three have the same average metal price over the life of mine, but they have fundamentally different economic profiles. This slide shows a CPI-adjusted long-term copper price histogram. The median price from 1959 to 2015 is about $2.30 a pound. The notion of reversion to a mean presumes, at least in the long run, that there isn't a structural break in the market that will keep prices from reverting back to the norm. One might ask that if $2.30 a pound for copper is the long-run average, why are today's market observers extremely depressed by current prices of about $2.15 a pound? Why is this long-term norm being looked at as a crisis? Does a supercycle induce or have a psychological element? Is this despair itself indicative of a structural break, or is it a temporary reaction? This slide encapsulates some of the concepts just discussed. The period covered is 2003 through 2011. The heavy blue line is spot price for copper, while the light blue line is a 3-year trailing average. The green triangles are prices derived from an analysis of reserve studies posted on CDAR. The green line represents the linear trend line for the green triangles, or the normalized price, if you will. Clearly seen is a divergence between the 3-year trailing average and the consensus as determined from the prices used for calculating mineral resources. Regardless of the method, forecasting of commodity prices, hence revenue, is an imprecise art. Consequently, so is the outcome of a valuation based on the forecast. The 3-year trailing average is an indication of where we are and where we have been in the commodity price cycle, not where we are headed. The DCF model is supposed to be based on future prices and costs in order to glean future outcomes. The price forecasting method that looks backwards to judge future prices will not achieve that objective. The oft-stated reason for using the 3-year average is to enhance reasonable comparability. Unless a comparison is done within a very short period, the desired comparability is likely to be elusive. A Monte Carlo approach avoids the traps of the single forecast and allows for exploration of a wider range of outcomes and their implications. This probabilistic model also explicitly accepts that neither the uncertainties, volatility, nor the cyclicity of commodity prices associated with the valuation of mining companies can wholly be removed from the process, as these are the very essence of the industry. Some recommend that the uncertainties related to forecasting metal prices should only be dealt with by varying the discount rate. However, the discount rate will punish all the variables in a DCF model equally and will still fail to recognize a metal price cycle. We propose that these failures can be rectified to a large degree by using discount rates for different lines, but this is a very tedious process and really doesn't achieve the objective. We feel that the Monte Carlo process is better suited for valuation of mining projects as it addresses the fundamental deficiency in many valuations that only consider the NPV of the base case outcome, which in essence applies 100% probability to that scenario. Other scenarios may be considered, but each will have their associated NPV without influencing the final outcome that is based on the base case scenario. We conclude that careful evaluation of long-term metal prices is a key element in establishing value for mining assets and is not a luxury that can be left to simple averages or rules of thumb. Careful analysis using a probabilistic approach like Monte Carlo analysis will, we feel, lead to more credible valuations. Well, thank you for your attention. Look forward to seeing you all in Monte Carlo next year.
Are there any questions? I think we have time for one. Yes, sir. You'd step to the microphone.
Took me a while to get going, but
That was fine. Everything was good.
My name is David Espinosa. Sorry if I sound a little bit contentious, but that's not the point.
that's why we're here.
I don't agree with. Unfortunately, right now the use of models like at risk and crystal ball looks like using probability analysis something very easy to use, and a lot of people does it, and I do it myself. But if the model you start with is wrong, doesn't matter how many simulations you do, the result will be wrong. You'll get the expected value of the wrong result. So I think thinking that by doing probability, by doing Monte Carlo simulation, you will overcome the pitfalls of net present value. I mean, I think that's the wrong message to send.
Don't forget that what I'm concentrating on here, though, is metal price.
No, that I'm okay with that. But I think at the end, when part of your message and the conclusion is that doing Monte Carlo simulation, it's a good way to overcome the uncertainties associated with the problem you're facing. Mm-hmm. And I think you're not gonna solve that problem with the simulation. So.
Any other questions?